I think it was inevitable that CQG down the road after 46 years was going to get bought by somebody or partner with somebody. And there's no other firms like us out there anymore. We're one of the last ones. And it really makes sense that it was Broadridge because it fits into what they needed, and it's good for us because it gets us not a small fry anymore, that we're bigger. To be honest, it's all been positive.
It's an interesting way to get client feedback. Some of it's very humbling, actually, just in terms of people's experience with CQG and what they're hoping doesn't change. So it's been an interesting way to hear from them, saying, are you guys going to still do this and still do that? And actually, it's very raw, kind of unfiltered feedback on what they appreciate about CQG. And I think it gives us some ideas on the things that it's going to be really important to preserve within Broadridge also.
Which definitely is the nimbleness that CQG has compared to a bigger Broadridge. And I think Broadridge would like to become a little bit better at that themselves. At least they've said that. Yeah. So we bring that to the table, I think, which is important. We want to keep that.
What are the biggest opportunities with the acquisition?
The goal is to end up with a true front-to-back, end-to-end solution. Like if you think of the A to Z of our whole industry, all the workflows, there are definitely parts of that CQG currently services, and there's parts that Broadridge services. This isn't even just combining those two things, but it's also taking a lot of their scale and their resources and their deep expertise on things around the order management side of things, post-trade, back office, but then CQG's knowledge on futures and options specifically as an asset class, some of the execution functionality, and creating a true end-to-end solution. I think the sort of thing that on our own we really could not have done.
What are the final impediments to 24/7 trading?
The 24/7, having the HR, having the people there to take care of it, that's important. But it really comes down that the problem is, we've talked to customers about it, we are 24/7, is the banking part of it. The banks are not open on Sundays. That's something that has to be looked at, and it depends on obviously what products you're trading and everything else. But it's here. We've been talking about it for a long time, and it's here now.
BOCA is an interesting conference because it's really like your canary that tells you what's going on in the world. Like this year, everyone's talking about prediction markets. Past years, it's artificial intelligence, the rise of retail, right? Blockchain, crypto. Every year, it seems like there's something different right now. It used to be every 5 to 7 years there's something different. Now it's every year there's something. At the same time, for whatever reason, every other year that we're down here in BOCA, there's something going on in the markets. It's always kind of fun to watch the demeanor of people down here because like our industry is fundamentally a transfer of risk industry. When I think of these things, whether it's the prediction markets, crypto markets, 24/5, 24/7, whatever they may be, the important thing for our industry is to still do risk properly. And that does get to the banking stuff over the weekend because how do you do margin? There's all these complexities there. But I think the most important thing is as these new things are coming in that we don't lose our focus on risk and protecting the customer and all these fundamental things.
When will AI move from a prototype phase to an implementation phase?
It does seem like it's still sitting in prototypes for most people. I think everyone understands they need to do something with AI, and I think that means a lot of different things. I do believe it's time for that to begin to migrate into real-world production. At some point, the ROI on all of this has to come through. One application right now, because of the pace of change with everything and all these new things coming on, I do think AI, even just deploying it in terms of making processes more efficient, will probably help everybody keep up with the pace of change. I think for it to really see its day, it has to move beyond process value into real, like productive value. For CQG, there's a lot of different things that we're talking about with Broadridge. There's quite a bit. Broadridge has made a very sizable commitment to investing in AI, not just for themselves as a firm, but also trying to make tools more accessible to other people that maybe don't have the ability to invest in the same level. That was one of the things that was attractive to us. I do feel like it's transformative. I also feel like it's dangerous to only go in halfway. And so I feel like it's the sort of thing, if you're going to do it, you need to do it well, you need to do it safely. You have to think a lot about customer privacy, customer data.
Using it for the process of writing to a new exchange that might take us 6 to 8 weeks or 3 months, we can shorten that time because that monotony of doing that stuff you can do with AI, and that's where it's helped. And that also takes down the price tag on what it costs to do it. So everybody's a win-win there.
How are retail and institutional investors using prediction markets?
The retail community seems to be adopting these event-type contracts, prediction markets very quickly. I think for the institutions to do it, they need institutional tools in place. Our industry's always had kind of this separation of duties. You've got exchanges, you've got brokers, you've got FCMs, you've got tech companies, right? Introducing brokers, trading firms. There's all these different participants. And I think that ecosystem has been really healthy. Generally speaking, pretty supportive still of the intermediated model. I think that the role of the FCM is incredibly important. And I think in this space, for institutions to adopt it, I do think you're seeing the more traditional FCMs trying to find a way to take the prediction markets and offer up to their customers. But I don't see the institutions going to these websites the same way the retail person would. I think they want to go through trusted brokers, existing processes. Risk management is still important.
We talk about regulation, sure. Does it need more regulation? I like the word that someone used yesterday, guardrails. You need guardrails to keep it, to keep it safe. And I think those still have to be put in place. And let's hope it happens before something bad happens. Either, you don't want something bad to happen and then you come up with the answer afterwards.
What are the biggest challenges for firms with all the changes in technology?
The biggest thing I hear is it's hard to keep up with all the things that are changing right now. And I think that's the role that we're hoping to play. Is technology is always been considered like the great equalizer that's out there. But generally what it does is it allows the startup to go compete with the incumbent. I think right now it's interesting because you have these, whether they're exchanges or FCMs, you have these firms that have been around for 100 or 200 years and firms that have been around for 2 to 5 years. And the 2 to 5 year old firms built the technology natively to do a lot of these newer things. And then you have the 100-year-old, 200-year-old firm that maybe is not a tech native company. And so how does CQG use technology almost to equalize the playing field so that the incumbent can continue to be competitive with maybe the emerging companies? So I think that's the role that we're hearing from people is, can we as the technology guys help build things and standardize it in a way where whether they're trading on an established exchange or a newer exchange, futures, predictions, whatever it is, their workflows can remain consistent and they can continue to do what they do around risk and we can just do what we do, which is the tech.